Hello and welcome to today's recorded presentation on tax rate bylaw overview, not a run-of-the-mill process. My name is Jordan Velaston. I'm a municipal financial advisor with Municipal Affairs, and this recording is April 2026. Um, I know I'm super exciting, but I'm going to close my video so you could focus on the presentation. So, generating revenue to fund municipal operations is obviously hugely important and critical for the sustainability of municipalities. And a large part of this revenue comes from taxation. There are several different types of taxes that the MGA allows municipalities to impose, including business tax, local improvement tax, special tax, and a few others. But today, we're going to focus on usually the most significant source, municipal revenue, which is property tax. Property tax cannot be legally imposed without creating a tax rate bylaw. So we thought this would be the perfect time to do a session dedicating on how to create this important bylaw. Great. This is an outline of what today's session will look like. Our primary goal for today is to give you a good understanding of the legislative requirements involved in the tax rate bylaw and highlight some important considerations that you need to keep in mind when developing your bylaw and preparing to send out tax notices. And to give you some practice with actually plugging in the numbers, we'll be working through a case study as well. Lastly, we'll wrap up with a brief teaser of what is to come regarding the revised tax information return. So, to start off the discussion about the tax rate bylaw, let's first take a look at a very high-level overview of how property tax process flows. The municipality's strategic plan would technically be the critical first step in developing the budget. The annual budget is critical and determines which infrastructure and services will be provided to residents and at what levels, which ultimately determines the tax rates necessary to fund them. The operating and capital budgets were to be passed before January 1st of the current year, but often an interim budget is done at that time, with the final budget approved by council early in the year after they have been given more information on assessment numbers and provincial grant funding levels. Once council determines the amount of money needed to operate the municipality, known revenues such as permits, licenses, user fees, and grants are subtracted, and the remainder is the amount of money the municipality needs to raise their property taxes. This revenue requirement and property assessment amounts are then used to calculate the tax rate. The annual tax rate bylaw required by Section 353 gives the municipality the authority to impose and collect property taxes. It's important to keep in mind that the terms assessment and taxation are related but not interchangeable. Assessment is the process of estimating a dollar value on a property for taxation purposes, versus taxation is a process of applying a tax rate to a property's assessed value to determine the taxes payable by the property owner. So let's take a closer look at how tax rates are calculated. The tax rate is a percentage of assessed value at which each property is taxed in the municipality. Section 355 sets out that the revenue requirement determined by the budget is divided by the assessment base. And so the total value of all assessed properties in the municipality. So formula budget requirement over assessment equals tax rate. So here's an example that uses round numbers in a municipality that charges the same tax rate to all of its assessment classes. This municipality has determined that $1 million is required to cover the operating capital costs, subtract other revenue sources such as grants and user fees. If its assessment base is $100 million, they need to apply a tax rate of 0.01. Some people might be more familiar with the term mill rate, which is what was referred to in the old legislation. The mill rate is calculated by simply multiplying the tax rate by 1,000 or moving the decimal to the right by 3 spaces. In this example, the mill rate would be 10. However, you won't find the term mill rate in the most current version of the MGA. Again, before tax rates can be calculated and applied, council has to approve the operating and capital budgets required for the upcoming year. Your municipality may have to pass an interim budget before the end of last year and will pass the final budget in the early part of this year. Now, question, which is the only part of the equation that the council has control over? They can't change the assessment value determined by the assessor, and the tax rate is simply the budget requirement divided by the assessment. So the only portion they can control over is the budgetary revenue requirement. Administration must ensure council is aware of the effects of the proposed budget on tax rates during their budget discussions. This is the appropriate time for discussion on how the revenue requirements will determine the resulting tax rate and not on the day you are hoping council to pass a tax rate bylaw. The preparation time leading up to the passage of the final budget is when you are going to want to present an example assessment rules, tax rates, and resulting tax bills to your council to reduce sticker shock when they are passing the tax rate bylaw. There should be limited discussion when it comes to time to pass a tax rate bylaw, as the bylaw is simply the resulting calculations using the revenue requirements already approved during the budget deliberations and the assessment numbers provided by your assessor. If council decides the tax rate resulting from the approved budget would be unacceptable, then the budget must be revised to reduce expenditures so that the revenue requirements are lowered enough to produce a lower tax rate that the council is more willing to accept. If budget reductions are made, council must specify what programs or services will be required and not simply ask administration to cut a certain dollar amount or percentage, as council is responsible for setting the budget and not administration. The only policy decision left at this point is how the burden of the budget requirement will be distributed amongst all property owners. But before we talk about that, let's look at assessment classes and subclass a little more closely. Currently, the MGA includes 4 broad classes of property assessment, with 2 of them allowing for further subclassing. These are important because assessment class or subclass determines the tax rate that will be applied to each property, as they can have different tax rates, as specified in section 354 of the MGA. Class 1 residential can be subclassed by bylaw to any extent that council considers appropriate. This is set out in section 297, number 2. Some common examples are vacant and improved, and multifamily single family. Rural municipalities may have subclasses for county residential and hamlets. The municipality should be prepared to explain and justify any difference in tax rates for residential subclasses. For example, there may be a different service levels in certain types of properties that would warrant a um, different rate in tax rates. Class 2 is non-residential, which is made up of dip and linear and commercial properties. Non-residential can now be subclassed into vacant, small business, and other non-residential. Class 3 is farmland, and Class 4 is machinery and equipment. Currently, these last 2 cannot be subclassed any further. Additionally, one or more subclasses may be assigned to a property. For example, a commercial building could have a residential component as a living quarters. Before an assessor can subclass the residential and non-residential classes, council must pass a bylaw. Since the assessment rule must be prepared by February 28th, this bylaw should be passed well before that. If the subclasses needed to be changed for that taxation year, That bylaw should have already been approved by council. This was a past example of subclassing decisions from an Alberta municipality. The council passed a bylaw that created subclasses for vacant commercial and vacant residential properties. This allows council to set tax rate for vacant residential property and vacant commercial property that are higher than non-vacant residential and commercial tax classes, which may motivate those which may motivate those owners to develop their own vacant land and allow the city to benefit from the jobs, services, and tax base that could be provided by that development. So, to reiterate, the MGA allows for different tax rates for different classes and subclasses. However, there are a few limitations to be aware of. These limitations would be a maximum tax ratio, which is established by section 358.1, a maximum tax, a maximum ratio of 5 to 1 between non-residential and residential rates has been set by this section. In other words, the highest non-residential tax rate cannot be more than 5 times the lowest non-residential tax rate. Another limitation is found in the subclassing regulation. Non-residential subclass. The tax rate for the small business subclass may not be less than 75% of the other non-residential subclass, and small business rate must not be greater than other non-res. Section 357 allows for a minimum tax payable as a property tax. If a municipality wants to ensure that each tax bill covers off the minimum costs involved with each property, such as costs for processing, mailing the tax, and assessment notice, it could set a minimum tax payable. It is important to remember that a minimum tax must apply to all assessment classes and subclasses. You cannot have a different minimum tax for each. The additional revenue gained when a minimum tax is applied should be reflected in the budget. We'll discuss this in further when we review the case study. Section 357.1, tax rates for residential, states residential tax rates must be set above 0. Why? Because of the minimum tax ratio. You get an undefined number when you try to divide anything by 0. And there are the sections we referenced, 58, 57 through 7.1. Tax rate restrictions. This is a bonus slide that gives you a visual summary of the assessment class, the subclasses, and the tax rate restrictions that are found in the MGA. One item I've not mentioned is a tax rate for the machinery and equipment must be equal to the tax rate for class 2. If subclasses are used in class 2, then it must be equal to other non-residential subclass. And don't worry, these slides will be distributed as well, so you can digest this information. Okay. A requisition is permitted on the tax rate bylaw only if there is a legislative provision authorizing it. These are the only 3 requisitions recognized in section 326 of the MGA, those being ASFF, Seniors Foundation, and DIP. Be aware that Bill 28 has received first reading. However, it is not passed completely yet in legislation. Upon passage of the bill completely, municipalities would be able to post policing costs as a requisition on their tax rate bylaw. So just keep that in mind. You will receive letters that advise the amount that your municipality has to contribute to these provincial and regional programs. Each municipality's share of these costs is calculated using equalized assessment, which is a bit different than the assessment amounts determined by the local assessor. Section 359.3, DIP requisition rates are set annually by our ministry. An amount set to cover the province's costs for administering DIP, and it is the same for all DIP properties province-wide. With respect to requisitions under Section 359.2, municipalities have the ability to establish a rate to recover what they believe will be uncollectible. This is to help the municipality meet their requirements to pay the full amount of the requisitions, even when they don't necessarily collect all of it from the taxpayers. The rate for this allowance cannot exceed the actual rate of non-collection the previous year. Also, more of an audit function, but each year your auditor will identify if you have an under or over levy with respect to any of the requisitions and then provide the appropriate increase or decrease that will that have to be adjusted for in next year's budget and the bylaw. This results from Section 305 changes that the assessor made to the individual assessment throughout the year. There's no requirement to show this amount on the bylaw, so it can be included as a budget item. Tax rate bylaw checklist. We have asked the MAP advisors for their list of most common errors they find with the tax rate bylaws, and when they review municipalities for legislative compliance. The next two slides are based on the list they gave us that shows some important questions that need to be asked before a tax rate bylaw is passed and tax notices are printed. Some of these seem quite a bit basic, but they're commonly happen in the field today. Has the budget been approved by council? As as I had discussed earlier, the expected revenue and expenditure numbers set out in the approved budget must be used to determine the tax rates that need to be applied to the municipal assessment. There is some risk that the tax rate bylaw being challenged if the tax rate bylaw was not passed before the budget was approved. Speaking of assessment, it is important to make sure the assessment numbers balance before the tax rate bylaw is passed. What I mean is on the day the tax rate bylaw is passed, your assessment file must balance to the assessor's file, both of which must match what the bylaw shows for the assessed values. This is because the assessor may have had to make changes to individual assessments under Section 305 after providing the assessment roll to the municipality in January or February. So you must ensure that the assessment totals in the bylaw also reflect these changes. Are the calculations on the tax rate bylaw correct? Sometimes numbers from your spreadsheet don't get transferred over to the bylaw properly, or maybe there was an error in the formula that went undetected. We recommend getting a second or third set of eyes to check the calculations on the final bylaw with the calculator. It is surprising how many bylaws have been found to have math errors. Just a reiteration of making sure you don't have any requisitions in your bylaw other than the three I talked about a few moments ago. We've seen municipalities include requisitions for fire protection and recreational services, which is not legislatively compliant. Instead, these costs for these services should be included in the budget or they could be imposed using a special tax bylaw instead. You also want to make sure the amount your auditor has identified as an over or under levy regarding your acquisitions from the previous year have been carried into your current budget year. This may sound obvious, but especially when you use the previous tax rate bylaw to create the current one, it is easy to overlook the dates when focusing on the numbers, so make sure they also get updated appropriately. As I had mentioned earlier, only one minimum tax is allowed to be applied to all assessment classes. A common issue we often see is when the current year's bylaw is rescinding the previous year's bylaw, which you do not want to do. Coming into a new tax year does not mean the previous tax year's taxes were never imposed. So you still need the previous year's bylaws to authorize the ongoing collection of taxes through tax recovery. When you're developing a tax rate bylaw, it's a good time to review the tax penalty bylaw as well to make sure what is going to be printed on the tax notices is consistent with both bylaws. Another question to answer is whether your penalty bylaw is explicit in that penalties are calculated on penalties because taxpayers often question that enough through the MGA and states that penalties become part of a tax. Speaking of tax notices, hopefully you will be taking some time to do some test printing to ensure all software updates haven't messed anything up since the last time they were printed. You will want to do a test print in a good sample of tax notices, including notices where every assessment class and the ones that you have multiple owners or multiple classes to make sure that the spacing is still correct, all the necessary fields show up, and all the calculations work properly. So these are just some common mistakes that we see on tax rate bylaws. I will discuss a slide in greater detail about common mistakes later in this presentation. As I alluded to earlier, if a significant error or omission requiring a redo is discovered after the tax rate bylaw is passed and the notices have gone out, Section 354 of the MGA permits the bylaw to be amended. Amended tax notices are sent out, and the ministry is provided with a copy of the amended bylaw within 30 days. Not a process you want to go through at all possible. So please make sure every effort to double check and triple check everything to avoid this. You're welcome to call us if you need help. As we mentioned, some common mistakes. This slide depicts three major categories of common mistakes that municipalities make on their tax rate bylaw. The first is grammatical, spelling, and proofreading. Some examples are not updating the current bylaw throughout the document, not properly providing or not properly dating and signing the bylaw, using incorrect tax rates, last year's or something completely different for DIP, errors in mathematical calculations. The second most common error is the bylaw is missing the items, mislabeling, has inconsistencies in key elements. Inconsistencies when defining key dollar amounts, municipal revenues from sources other than taxes, total municipal expenses, and the amount that the municipality will need to collect via taxes. Another is including non-requisition items such as recreational funding, example, etc., which is with actual requisitions, seniors, housing, DIP, and education requirements. Using different amounts for the same item when it shows up in different parts of the bylaw, such as assessment amounts or levy amounts in the body of the bylaw, do not match those listed in the summary tables. Another is not including assessment amounts for every taxation category. And lastly, not including the minimum tax amount per property, nor the minimum estimated amount to be collected when it has been used in municipalities' calculations, etc. And the third common type is including requisition amounts as part of general municipal taxation. Requisitions are not part of general municipal taxation. Yes, they are collected, but it should not be included as part of the general municipal taxation portion. Well, we understand that there is no defined approved template that this legislative for municipalities to follow for tax rate bylaw. Our submission requirements are based on the fact that all the math elements on the bylaw should add up. Now we will continue with the case study. So here we have our case study set up. You can find this on our municipal affairs website, which a link has been sent, and we will send again. So this is a new sample for tax rate bylaw case study. Again, it's just for practice. These are made up numbers, but a good practice for you to run through. So we'll start with the case study, and then we will kind of correlate this and how it gets plugged into a tax rate bylaw. So we have our revenue requirements, or our revenue for sake. We calculate our total revenue, and then we can solve for net municipal revenue, and this is numbers to be calculated. We have our expenses. Notice this amortization at the bottom there, our expenses. So we take our total pre-tax revenues, subtract our operating expenses, and add back amortization since it's a non-cash item, operating revenue requirements for municipal taxation purposes. However, we're not done yet. So we have a couple more items here. We have our capital budget summary. So our revenue for capital budget summary, 700,000. Expenses for capital budget summary is 850. The difference is 150, and this is a requirement we would need to collect from municipal taxes. We also have debt principal requirements, 100,000, and capital reserve requirements, 75, which is 175,000. There is also requisitions listed, residential farmland, non-residential, seniors foundation, designated industrial property, and our assessment classes. Residential, residential subclass, farmland, non-residential, non-residential subclass, machinery equipment, and designated industrial property. Now we're going to get into just some more details before we jump into the tax rate bylaw. So 70% of taxes will be, or of the composition of the municipality is residential, 30% composition is non-residential. Of the 70% residential, 90% collected are from residential, 10% collected from residential subclass. Of the 30% non-residential, non-residential accounts for 80% to be collected for non-residential and 12% collected from non-residential small business. And please note for this example, municipal tax rates for residential and farmland assessment will be equal. Municipal tax rates for non-residential machinery and equipment assessment will be equal. The allowance, non-collection of taxes is 0 for the current year, and the minimum tax rate will be $500. Sorry. So now let's see how these numbers go into the tax rate bylaw. So starting with the start. And there's green tip boxes here as well that we'll go through as well. So number one, council must adopt an operating budget and capital budget, which is section 242, 245 respectively, or an annual budget, which is 248.1 by January 1st of that calendar year. So on the tax bylaw, whereas the estimated municipal revenue from all other sources other than property taxation. So revenue, other sources other than property taxation, 855. Put that here. So 8, 5, 1, 2, 3, 2. Okay. Whereas the estimated expenses set out are 2526. However, it excludes non-cash items, so we have to take away amortization from that. So we do equals our 2526, 1, 2, 3. Subtract the amortization item, non-cash. 3. Correct. Okay. The estimated amount required to pay principal on any loans we have, we said that was 100,000. 100. And amount of money required for current year capital expenditures. So that was in our capital budget requirement was 150. The 1, 2, 3. And the estimated amount required for capital reserves to be transferred or transfers to capital reserves. We got that was 75. Okay. Therefore, the total amount to be raised by general municipal taxation is 1596. Before we go further, let's let's review the allocations tab just to make sure we did that correctly as well. So this transferred over. Total amount to be raised by general municipal taxation 1596. Going to the bottom of our case study here, we know the composition of the municipality is 70% residential, 30% non-residential. We know of the 70% residential, 90% collected from residential. We have that here. So composition 70-30 of residential, 90% is residential, 10% is residential subclass. Of the non-residential 30%, 88% non-residential, 12% non-residential small business. Okay, so we know we got the allocations correct. We'll go back to the case study. So we ended up here. So just to outline how this was calculated again, total municipal taxes required as expenses minus revenue plus debt requirements plus capital expense plus future capital savings. A municipality may choose to show an under or an over levy in the requisition section of the tax rate bylaw as a separate item or to include it as part of a main requisition. And a municipality may include an allowance for non-collectible taxes, which is section 359. So let's continue here. So the requisitions, as we mentioned in the PowerPoint or in the presentation, ASFF are provided by Alberta Education. DIP is provided by Municipal Affairs, and Seniors Foundation is provided by the related Seniors Housing Foundation. So let's fill in these requisitions. So we know these were residential farmland, 210, 500, 500, under an over levy of 10,000, 3, non-residential of 94, 500, 100, and allowance for non-collectible taxes. We have our designated industrial property, 681, and we have our seniors foundation of 21,500. Okay. So now we are going to fill in the assessment classes. So as mentioned, municipality may by bylaw establish a small business subclassification for a non-residential assessment. So let's take a look at these assessment classes from the case study. So residential and farmland combines them up equals. So we add them together. 9,200. 3 plus our farmland, which is 631. 631,000. We know our residential subclass is 5 million. 5, 3, 1, 1, 2, 3. We know our non-residential is 15. We know our non-residential small business is 5. We know our designated industrial property is 9721. We know our machinery and equipment is 4650. And that gets our total assessment value. All right. That gets a total assessment value. And please note that designated industrial property is not a major assessment class, but it is included in non-residential and our machinery and equipment classes. DIP as shown above is for requisition calculation purposes. However, DIP is included as part of non-residential assessment. So we just showed it there to spread it out, but it is non-part of residential assessment. So all of this, how do we calculate the tax levy? So we know our assessments. We need to calculate the tax levy because we have these different classes. So how do we do that? Well, here we go. We know how much we need to collect. So residential farmland, we know our allocation. So residential farmland, this is our total tax to be raised. So we'll click on that guy. Times our composition. 70% we know is residential. Of the 70%, we know 90% is residential. We know the 10% is residential subclass, which is our next one right here. So residential subclass. Total raise requirement times 20% is residential. This time times subclass 0.1. There we go, gets our residential subclass. Now we're going to do non-residential machinery and equipment. Still have our total amount we need to raise, but this time it's non-residential. So we're going to multiply that by the non-residential composition, which is 30%, times non-residential, which is 88%. And now we got the non-res small business. So equals amount we need times, we know 30% in non-residential and only 12% is the small business. There we go. And we know we did it right because it adds up to 100%, 1596. Total assessment is the same there. And that actually, once you go to tax rate, so we got our tax levies and that calculated our tax rates. Tax levy divided by assessment equals our tax rate. So now you got our tax rate. You're not done yet. You got to make sure a couple things are still correct. So Section 397 establishes 4 major assessment classes: residential, non-residential, farmland, machinery, and equipment. Section 354 authorizes different tax rates for each assessment class. So we're just kind of doing a brief summary of what we learned in the presentation. The highest tax rate for non-residential properties must not be higher than 5 times the lowest tax rate for residential properties. So we know our lowest tax rate, which is this one for residential. We know our highest non-residential is that one, is this one. And we know that it's only 1.3 times. It's not greater than 5, so we know we're okay. Also, we have to make sure that tax rates for small business property must not be less than the other non-residential property. So tax rates for small business property is that guy for non-res. Tax rates for non-res is this one. And we could see it's 80%, which is not less than 75%. So we are okay there. We also know that the provincial assessor provides municipalities with a DIP rate to charge for the DIP requisition. For 2025, the provincial assessor provided a DIP rate of 0.0000701. And please note the rate changes every year. 2026, it will be different. And just make sure you have that updated one on your tax rate bylaw. Municipalities are required to set the same local school rates for the public, ASFF, and separate opted-out rates school board supporters for each class of property after section 160 2B of the Education Act. And under ASFF, municipalities may choose to have a separate line for under and over levies, or can include within an existing requisition. The under levy above is included within residential and farmland. Okay, now, as we know, there's a minimum tax in the case study, $500, as summarized in the presentation. The MGA allows for only one minimum tax rate. Section 357, revenue generated from the minimum tax should be included in the budget and shown on the property tax bylaw. Okay, so now that we have gone through the property tax bylaw, again, this is just a general tax bylaw. Every municipality is unique and will have a very slightly different tax bylaw. However, they should all look similar. So now we're going to, so now that you have built a tax rate bylaw, you think it's all over. Well, it's not. Stay tuned as we invite you to attend our next virtual session on April 16th, where we will explore how to submit the tax rate bylaw and the tax information return template to municipal affairs. This presentation will review how to complete the tax information return with common mistakes and error flags that may appear when completing it. If you have not seen already, my colleague Angela Bilski did a wonderful presentation on tax recovery not long ago. This presentation discusses in great detail taxes related to land and designated manufactured homes. It's a great presentation for all things tax recovery, and the link is provided here in the slide. And that concludes our presentation today. I hope you enjoyed it. I know it was a lot of information to go through, but just take your time. Feel free to call us if you have any questions. We're always more than happy to help. And yeah, have a wonderful day, and we'll see you again next time.